Happy New Year and thanks for joining us for today's Ag Update. Well, it doesn't look like there's a lot of upside in the grain market, at least in the short run, but there are some significant improvements to crop insurance and the farm safety net that will benefit growers here in 2026. It's a result of Farm Bill priorities that were included in the One Big Beautiful Bill. And to walk us through the changes, I spoke with Korey Fauque of KW Insurance. First off, Korey talks about some significant benefits to beginning producers.
So if you're a new farmer coming back, you get 10 years of farm experience before these discounts go away. You're going to receive an extra 10 points as premium subsidy the whole time. And for the first 5 years, you actually get 15 points basically on average kind of through that. So huge help, basically cuts your premium down to a quarter for a lot of these beginning farmers compared to somebody that's established. So we need some help getting young guys back in this. It's not a very fun time, but that really can help.
And that encourages getting as many acres in the hands of new producers to help them take advantage of the benefits.
We don't want to get a farmer started, a young guy in your operation with only 100 acres, let's say, or something. It would be better to have them help you on the farm and then roll them into it at a bigger scale, because the discounts, not only through us, but through the FSA are really quite substantial anymore to help get these beginning farmers going.
Korey also says there's some big improvements to SCO and ECO that'll help growers not only save costs, but better manage risk.
So SCO and ECO last year were subsidized at 65%. Now it's 80%. That effectively cuts your premium in half. Anymore, those county programs are really a no-brainer for everyone to be in, because your odds of getting a return are so incredibly high off of those. And I think those very well might be your disaster programs going forward. That was the focus of the increased subsidies.
It was the 2014 Farm Bill that created the ARC and PLC programs, but they haven't paid growers much here in the last couple of years. However, finally, we saw reference prices increased, and that will benefit growers later this year.
So we got a step up on wheat from $5.50 up to $6.35, I think it was, and that's going to trigger about $1.35 a bushel payment on wheat, which is huge. So we're going to see those payments coming in the fall of 26 for the poor 25 crop year. And that's something we can take to the bank. I mean, that's actually established there, so that's going to help your operating renewal.
And what does the increase to base acres mean to growers?
Every farm number has a certain number of base acres of wheat or barley, let's say. It doesn't matter if you seed peas on that farm. These disaster programs pay on what you have for base. That number usually is set at roughly half of what you have because it was crop fallow, right? Well, a lot of us now started cropping more than half and half. So they're going to allow us to step those base acres up closer to what we're actually seeding on each farm number now, instead of just using half the acres we're seeding.
Thinking about crop insurance options, Korey says that revenue protection offers substantial advantage to growers over yield protection.
I've run so many scenarios for guys where their agent just never went through this stuff with them, right? Or they never switched them from yield protection to revenue protection. It can cost an average size grower. The one I just ran was $500,000 in 10 years. And it could be substantially more than that if you hit some drought years. So there is really no logical reason not to be in revenue protection. The government gave us that option. They just still left the yield protection thing in place. I would really look at your policy and make sure it doesn't say YP on there.
And when you stack these programs together, the benefits to producers are huge.
Like on SCO and ECO, if it triggers, let's say average is $50 an acre when that triggers. That doesn't seem like a huge amount of money in 1 year, but if that triggers 6 or 7 years out of 10, that's a lot of money, right, per acre that we can realize in indemnities. So especially with the new subsidy rate, those programs make a lot of sense.
And lastly, on the cattle side of risk management, Korey says that livestock risk protection may be worth considering at this point in the cattle cycle.
LRP, they came out with that program several years ago. We have hit such an increase in the cattle market that if there was ever a time to do it, it's now. And you can put a bottom on this thing at about 5% drop for maybe $50 a head on the calves that are in the cows right now. So we could lock in the price on the calves and the cows and any yearlings you have all out to next year and take one more year of advantage of this. And we saw a lot of it last year that guys were in, and now they're just sort of sitting in shock watching things go up and down. But if we reset back to 250 or something here, it could be a substantial loss of income on the ranch if you don't have some kind of bottom side protection. And with this stuff, you don't need a hedging account. You can do any number of head of cattle you want. You can pick as far out of the market as you want. You can get it cheaper or more expensive. Just really good option.
Well, a big thanks to Korey for his insights on these programs and all the changes. For the Northern Ag Network, I'm Colter Brown.